We're going to continue our discussion for deductions for AGI with the deduction for half of self-employment tax. Self-employed individuals pay self-employment or FICA tax that's equal to 15.3% of net earnings from self-employment. This covers both the employee and the employer side of those FICA taxes. Net earnings from the business that are used to calculate that tax are the business revenues minus the business expenses. Self-employment tax is going to be calculated on Form SE, and the SE is going to be filed with the taxpayer's Form 1040. Self-employed taxpayers are allowed a 4 AGI deduction equal to 1/2 of the amount of self-employment taxes that are imposed. The amount related to the employer's portion for self-employment tax is an above-the-line or 4 AGI deduction for 7.65% of net income. Let's do a quick concept check question. The deduction for half of self-employment tax is based on which of the following? Well, it's going to be based on the net earnings of the business. So the business's revenues minus their expenses would be their net earnings. So next we have another deduction that's for self-employed individuals. This is the self-employed health insurance deduction. Self-employed individuals are able to deduct up to 100% of self-employed health insurance payments. The amount of the deduction may be limited in 2 respects. First, taxpayers cannot take a deduction for the amount in excess of net earnings from self-employment from the trade or business under which coverage is provided. So this means that the self-employed health insurance deduction can't cause your business to have a net loss. You can't claim more in a deduction than what that business earned for the year. The second limitation pertains to the availability of other healthcare coverage. If the taxpayer is eligible to participate in another subsidized health plan that's maintained by either the employer of the taxpayer or the employer of the taxpayer's spouse, then the deduction is not allowed. The eligibility for this is determined on a monthly basis. The next deduction that we're going to take a look at is the penalty on early withdrawals of savings. If a taxpayer withdraws funds early from a time deposit account like a CD, the taxpayer may be subject to an early withdrawal penalty. Usually this is, depending on the CD, it could be like 3 months worth of interest for the CD. The taxpayer is entitled to report the penalty as a 4 AGI deduction on line 30 of the Schedule 1. The amount of the penalty is reported to the taxpayer on Form 1099 INT that's issued by the financial institution that holds the account. So next we're going to talk about alimony. Now the new tax law did affect this as well too, but not until 2019. So in 2019, alimony is no longer going to be deductible by the payer spouse or included in the income of the recipient. However, this rule is only going to apply to divorces or separation agreements that were executed after December 31st, 2018. And it will also affect those agreements that are executed on or before December 31st, 2018, but modified after that date to include these new provisions. For those agreements that were executed on or before December 31st, 2018, and were not modified after that date, the respective parties will still be able to deduct the payments and be required to include those payments in income until those agreements expire or are modified. So for 2018, the prior alimony rules are still going to be in effect. For 2019, those will change. So alimony is one of the 3 potential payments that can exist in a divorce or legal separation. The alimony is 1, child support is the 2nd, and then property settlements are 3rd. Only alimony has a tax consequence out of those 3 payments. If the payments properly qualify for alimony, the payments are deductible by the taxpayer that pays the alimony, as a 4 AGI or above the line deduction. In order to qualify as alimony, a payment must be in cash, meaning money. It doesn't mean it actually has to be in cash. It could be a check or a bill that's paid. It must be required under the provisions of the decree of divorce or separate maintenance agreement. So if there are additional payments that are made that weren't required, that would not be considered alimony. And all payments must end at the payee spouse's death. The recipient of alimony payments would need to include these payments as income on their tax return. If alimony payments decrease sharply in the second or third year of the payments may be subject to a recapture provision. This means that if that occurred, that if the payments decrease sharply, that in the first, second year of the settlement, they were trying to reclassify property settlements to alimony for tax benefit purposes. Let's take a look at an example on how alimony paid is handled with the tax law. The Renfros were granted a decree of divorce in 2014. In accordance with the decree, Josh Renfro is to pay his ex-wife $24,000 per year until their only child, Evelyn, who's now 10, turns 18. And then the payments will decrease to $14,000 per year. For 2018, how much can Josh deduct as alimony in total? Well, he's making a payment of $24,000. However, since the amount decreases when their child turns 18 to $14,000, that difference in between the 24 and the 14, the $10,000, is most likely child support. So Josh would only be able to claim the amount that isn't child support, so the $14,000 as alimony. Okay, the last thing that we're going to talk about are educator expenses. Eligible educators can deduct up to $250 per of qualified educational expenses as a 4 AGI deduction. If the taxpayer's filing status is married filing jointly and both individuals are eligible educators, then the max deduction is $500, but neither spouse can deduct more than $250 worth of his or her expenses. An eligible educator is a teacher, instructor, counselor, principal, or aide in a kindergarten through 12th grade school who devotes at least 900 hours in the school year to that job. Qualification for that 900-hour test is measured within the academic school year, and the $250 deduction is measured in terms of expenses that are paid during the calendar year. Qualified educational expenses for the deduction are books, supplies, equipment, including computers and software, and other materials used in the classroom. The expense must be ordinary and commonly accepted in the educational field and necessary, which means it was helpful and appropriate.